So the Bank of Canada just held their interest rate increase press conference, and they said that they were extremely surprised by one major element of the Canadian economy. Now, the reaction to this surprise will impact every single Canadian because they actually think that this surprise was actually your fault. Now, until they start to see some evidence that you're actually feeling the pain as a result of this new decision, they're likely to keep on impacting the housing market, job market, and overall Canadian economy with their actions. So we have to start with, what is this surprise? Why is it your fault? And how is it going to impact everything? So let's start at the beginning. What happened just a couple days ago? The Bank of Canada increased interest rate, their overnight rate, their policy rate, by 0.25 percentage point, taking it to 5%, the interest rate set by the Bank of Canada. And they did this because they were surprised by one element of the Canadian economy, which is right here, surprisingly strong demand. The whole point of them raising interest rates was to fight against inflation, and to fight against inflation, you have to fight against demand because the price of goods goes up when there's an imbalance between demand and supply. So if you can bring down demand by making it more expensive to buy things, by putting a higher interest rates on these things, or on debt in general, well, then their idea is that demand will go down. And over the past year and a half, the Bank of Canada has been raising interest rates extremely quickly to do this very thing, but it hasn't been working as well as they would have hoped to because they were surprised by the amount of strong demand here. They said consumption spending per capita across a broad range of goods and services surged unexpectedly in the first quarter. And based on recent retail sales data, strength in goods consumption seems to have continued. In addition, spending on services has been robust, continuing to recover from the impact of the pandemic. So they're saying, hey, we thought that you would be feeling a little bit more pinched from these high interest rates, but we're confused. You're still going out and you're still buying things. So all of the people at the top committee at the Bank of Canada sat down, they put their thinking caps on, and they said, why is this strong demand still here if we didn't expect it to be given our interest rate increases? And here's the answer that they came to. Listen to this.
Growth has been surprisingly strong, and the economy remains in excess demand. Consumer spending on services remains robust. And while spending on many goods that are typically sensitive to interest rates has slowed, it has not slowed by as much as we expected. The housing market has also seen some pickup in activity. Several factors appear to be supporting household spending. The labor market remains tight, even if there are some signs of easing. The unemployment rate has increased slightly, but remains historically low, and wage growth has been between 4 and 5%, higher than what is consistent with price stability. Many households also accumulated savings since the beginning of the pandemic. Some households have cut back on spending because inflation and higher interest rates have eaten into their budgets, and some are being severely squeezed. But for many, larger savings may be acting as a buffer and supporting consumer spending.
So an interesting answer, and it can kind of be broken down into 3 different categories, with the first 2 kind of relating to each other pretty strongly. The first one being a tight labor market. The Bank of Canada thinks, okay, if it's very hard for businesses to hire people, well, that could actually be an inflationary pressure because of the second element, low unemployment. When businesses have a hard time hiring people, they have to pay them more to do so, right? Not only does that result in the individual who's working for that company or for that business getting more money, which they could then go and spend in the economy, it also can impact the pricing of the products, the goods or the services that the business sells, right? If you have to pay more for labor, well, then maybe you're going to raise your prices more frequently, and that could add to inflation. The second element he points to is high pandemic savings, or sort of Canadians that have a lot of savings as a result of not going out and spending as much as they would have during the time that the pandemic was a chief concern. Now, I think that this number is a little bit misguided, largely because they probably look at the average of this, when in reality it's likely the people that were already doing well and had the ability to save during the pandemic that are contributing to this higher savings rate, while the people on the middle and lower sort of class end of things, or at least wealth side of things, well, largely they don't have those savings. So they say that all of these things put together is what's causing so much demand in the economy, and the reason that they were surprised, given that they've raised interest rates so extremely quickly, they didn't expect to see such strong consumer demand and such strong consumer spending. And those deliberations are likely what helped them come to the decision to raise the interest rates by another quarter of a percentage point, 0.25 or 25 basis points, right? They're saying, okay, we need to do a little bit more work here so that we have more unemployment and lower or less tight labor market, right? Make it easier for people to hire individuals to work at their businesses, make it harder to keep and hold a job, and also make it harder for people to get larger wage increases. All of these things that they're saying are contributing to inflation, or at the very least the demand side of the demand and supply equation. But there are two areas that the Bank of Canada doesn't really talk about until later in the press conference, but they're two extremely relevant topics to this conversation, both of which I think that they get their messaging and their analysis a little bit wrong. Now, we're going to talk about both of these things. We're going to talk about the battle currently going on between the Bank of Canada and the Government of Canada when it comes to housing in just a moment. But first, listen to this clip, which gets at the first point we're going to talk about.
What are your thoughts on the current high levels of immigration that we're seeing? Do you see it as being more inflationary or disinflationary in the short run?
On net, it's probably roughly neutral. Immigration adds supply, it adds new workers. Immigrants coming, many of the immigrants coming in, the labor market's very tight, they're finding jobs very quickly, some taking a little longer, but what we're seeing is the labor market is snapping up those new workers pretty quickly. That's adding to supply, and that is easing some of the labor shortages, the pressures in the labor market. And if you can ease the cost structure the cost structure for companies, that helps ease inflationary pressures. On the other hand, these new immigrants, these new entrants in the economy, they're also new consumers. They're new renters, they're new home buyers. So it's also adding to demand. It's hard to know exactly what the net effect is, but I think the main message is that it's adding to both demand and supply. If you start in an economy with excess demand, you add both demand and supply, you're still in excess demand.
So he says we're starting off with an economy that's already overheated. There's too much demand, not enough supply. And he says, okay, all the new Canadians, all of the immigrants coming into the country, well, they on average will kind of not have any impact on that supply and demand side because they simultaneously, while adding demand by needing to buy more things, buy housing, rental accommodations, all of these things, he's saying, well, also they'll help the supply side of things because they'll be able to get jobs more quickly. Businesses will be able to hire more easily. All of a sudden, you don't have to give as many wage increases to the people that are working there, and maybe you don't have to raise prices as frequently to pay for those wage increases because you're able to find labor more easily. So he says, okay, net on all of it, it probably ends up being even. But I think that this is a little bit wrong, at least when you look at it from two different perspectives, the short term versus the long term, which paint different pictures in my eyes. On the long-term side of things, I think that they're probably pretty close to right. Eventually, this will end up net neutral after 10 years. There'll be sort of impacts on supply and demand equally. But I would imagine that in the short term, that the demand actually shows up a lot more quickly than any sort of supply side sort of relief, right? Or increase on the supply side, right? When new Canadians come into the country, they immediately need to start purchasing goods and services. They immediately need housing. All of these things that are immediate needs and that they'll immediately spend their money on would likely increase demand faster than any sort of help that they could be on the supply side. Sure, they could get a job more quickly, but is that really going to feed through to consumers in terms of lower goods prices and potentially lower the costs for businesses? That I'm not so sure about. I'd argue that over the short term, immigration likely isn't a net neutral on inflation. It probably increases demand more than it increases supply, at least in the short term. But this is only one of two ways that I think the Bank of Canada's job is being actively made harder by the policy decisions of the Canadian government, right? The Bank of Canada is trying to reduce demand as much as possible, while the government is making some decisions which ends up increasing demand. And it doesn't just apply to demand from new Canadians coming into the country. No, we need to have a talk about the elephant in the room, and that's housing and real estate values. But how does housing and real estate values impact consumer spending and demand in the economy? Well, let me explain this because once you understand it, I think it's going to make a lot more sense. For many Canadians who own homes today, the value of their home largely impacts the way they think about their spending and their financial situation. If you have a home that seems very, very valuable, maybe you have a lot of equity in it, of course you're going to feel a little bit more wealthy, and then maybe that's going to impact the way you think about spending. You're not going to think as much about going out to a store and purchasing something if you feel like you're more wealthy from the value of your asset or your home, right? This is something called the wealth effect, and it leads to a pointed question that was actually asked later on, actually the very last question of this entire press conference. Is it possible to bring down demand in the economy and thus bring down inflation if real estate prices are still high and people still feel wealthy and spend like they're wealthy?
Is it possible for the Bank of Canada to bring inflation back to target while the housing market is relatively strong? We'll close there.
Well, actually, what you can see in our monetary policy report in, I think it's table 2. Table 2. So you can see the contributions to growth from the various components: consumption, housing, business investment, government, imports, exports. So what you can see is that in 2023, we've seen a big contraction in the first half of 2023 in the housing sector. So housing actually contributes negatively to growth. 2024, you've already seen the housing market start to pick up. Our forecast has that continuing with modest growth. So in 2024, housing contributes positively to growth. Nevertheless, consumer spending slows quite a bit from what it was this year, and consumer spending is a lot bigger than housing in GDP, so the net effect is that growth overall slows. So the short answer is yes.
So the governor of the Bank of Canada here, Tiff Macklem, answers this question in a little bit of a weird way, one that I don't think really gets to the heart of the question. Now, Tiff here is saying that housing actually negatively impacts GDP right now because house prices in many areas were down year over year when we're looking at this data. But let me pull up the chart here that actually shows what he was talking about, the chart here. He's saying, okay, well, housing is actually not that big of a component when it comes to GDP growth because it was actually negative 1.1 for 2022, and consumption is actually the larger thing, 2.5, 1.5. These are the percentage contribution to the average annual GDP growth. But this is kind of weird that he's even looking at this chart when he was asked this question, because this chart is about GDP growth, not inflation, not about supply and demand and consumer spending and the things that actually impact inflation. The question's about inflation, not GDP growth. So I think it's a little bit odd that we're talking about GDP growth, not inflation, in the context of this question. And second, he kind of fails to draw the line between house prices and consumer spending via the wealth effect that we talked about previously. Now, one of the Bank of Canada's biggest superpowers, almost their only superpower, is to impact the way that Canadians feel financially by altering interest rates, by changing their monetary policy. In theory, they can impact the likelihood of spending via those interest rates, thus controlling demand. But I'd argue that Canadians aren't actually feeling the pain as sharply from these interest rate increases as they should, as a result, yet again, of more Canadian government policy and some of the decisions by the big banks and big bank regulators in Canada. Let me explain. You see, the government is actually trying to make it easier for Canadians who are struggling with high interest rates today, which is a noble sounding thing. You want to help Canadians, right? Make sure they're not struggling too much. And in order to do that, they're allowing different types of mortgage relief to take place in the market, like amortization extensions, which, as a short explanation, that's just stretching out the amount of time you have to pay your mortgage so that each individual payment is lower. So actually, let me show you this clip from my previous video where I explain exactly what I'm talking about here and show you it actually in the most recent budget, how the government is trying to make it easier for Canadians who would have otherwise been feeling pain from the Bank of Canada's rate increases. In the most recent budget, which I have up here on the screen, they even outline how they want to make life easier for the people who bought at the top and are seeing higher mortgage payments as a result of the Bank of Canada's increased interest rates. It's called a Code of Conduct to Protect Canadians with Existing Mortgages. Right inside of the 2023 budget, through a number of different measures, they're trying to sort of formalize the ability to extend these amortizations out past 25 years. They say this guideline will ensure that Canadians are treated fairly and have equitable access to relief, which will help more Canadians afford the impact of elevated interest rates. But you might be saying, the whole point of raising interest rates is to make people feel the impact of that to fight against inflation, right? So it feels like there's one force, the Bank of Canada, saying we want to make people feel poor so that they stop spending so that we can control inflation. And we have the federal government saying we don't want people to feel bad. We want to prop up our GDP numbers. We want to make sure that these people with mortgages aren't feeling the pressure. We want to be good to them, they might be saying. So overall, the Bank of Canada is shocked by how strong the Canadian economic numbers have been looking. So they raised interest rates yet again to try to cool it down more to avoid inflation as a result of this high demand. They think that the high demand is a result of a tight labor market, low unemployment, and a little bit of pandemic savings. So this interest rate increase is supposed to slow down job growth, raise the unemployment rate, and slow down consumer spending as a result of this. They want more people to lose their jobs, or at the very least not get as large raises to decrease demand. But they do tend to ignore the short-term impact of Canadian government policy that directly counteracts their attempts at lowering demand, largely an expansion of immigration and a sort of shield for Canadian homeowners so they don't feel the true impact of these interest rate increases. So obviously a lot going on here and a lot for us to follow moving forward. Do you think that the Bank of Canada is doing the right thing now, raising interest rates to make sure that inflation doesn't come back? And how do you think the government sort of plays into all of this? And maybe they're sort of needing a lot of these policies to sort of make their numbers look good, or even to sort of increase growth over the long term in Canada. I'm curious what you think about it. What have I missed here? Where am I wrong? Let me know down in the comments below. I read every single one and try to get back to a bunch of them. If you haven't already done so, make sure to subscribe to the channel. And with all that said, thanks so much for watching, everybody. Really hope this video helped you out at least a little bit, and I'll see you next time.